Good morning, students. Welcome back to my accounts class. We have done the treatment of goodwill brought in cash. Today we will discuss, or rather I'll explain to you what is the treatment of goodwill not brought in cash. We will apply this in question number 57. Open to page 3.162 of your accounts books. We have A and B in partnership, sharing profits and loss in the ratio of 3:2. On 1st April 2018, they admitted C into partnership, who brings in rupees 50,000 as his capital, but nothing for goodwill, which was valued at 40,000 for the time. This is the goodwill of the firm, or new goodwill at the time of admission of C. We have to find in this what is the new partner's share of goodwill. He acquired 1/5 share in the profits equally from both the partners. That means A and B sacrificed equally, half of 1/5 by A and half of 1/5 by B. It was also decided that land and building to be reduced or written off by 20,000, stock be written down or reduced by 3,200, a provision of rupees 1,000 to be created for doubtful debts on debtors, an amount of rupees 1,200 including sundry creditors to be written off as it is no longer payable. The balance sheet is given below. In the balance sheet liability side, we have one adjustment called general reserve. General reserve is an undistributed profits which will be transferred or credited to old partners' capital account in their old ratio. While on the asset side, we have goodwill appearing in the balance sheet. It will be transferred, written off or debited to old partners' capital account in their old ratio. You are required to prepare reversion account, partners' capital account and the new balance sheet of the firm. You can see on the board, I have found the sacrificing ratio as well as the new partner share of goodwill and the reversion account. Since C acquires equally from A and B, half of C's share, 1/5, gives you 1/10, surrendered share. B similarly sacrifices, surrenders half of new partner's share, 1/5. Also, surrendered share is 1/10. Therefore, sacrificing ratio will be 1/10:1/10, or you can write directly 1:1, equally. Goodwill of the firm on C's admission is 40,000. C's share we have to ascertain. His share in the profit is 1/5. So 40,000 into 1/5 gives you 8,000, which he does not bring in cash. So the general entry for this will be new partners current account debit to old partners capital account in their sacrificing ratio. So C's current account will be debited with his share of goodwill 8,000, credit to A's capital account to B's capital account in their sacrificing ratio of 1:1. So 4,000 each will be credited. Then they have asked to prepare reversion account. Since land and building stock are decreasing, decrease in asset will be debited with their respective amount of reduction, 20,000 and 3,200. Provision is to be created, means liability, increase in liability will be debited. For doubtful debts, 1,000. Creditors are no longer payable, don't have to pay any money to this much money to the creditors, so you have to show as decrease in liability, gain credited by creditors 100. The difference of the reversion account shows a loss of 23,000, which will be transferred to old partners capital account in their old ratio.